Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Fall Webinar Series. This program is entitled Tax Planning for Expatriation. For those who don't know me, my name is Jonathan Shenkman, and I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 15 to 20 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. My most recent piece was published in Barron's this week and discussed investing in artwork. After the program, I send out a link to this piece and a variety of other periodicals where I publish my work. Today, we're privileged to hear from Eli Akhavan, Senior Counsel in the New York office of Norton Rose Fulbright. Eli focuses his practice on tax and estate planning for high net worth U.S. and non-U.S. clients, where he advises international individuals and families with respect to tax and estate planning for the U.S. assets and beneficiaries. Eli also advises cross-border clients on all the aspects of international estate matters, including foreign trust, pre-immigration and expatriation planning, and on planning for the purchase of U.S. residential and investment real property. Eli has considerable knowledge on the reporting requirements applicable with respect to foreign financial accounts and assets respect to FATCA and its global equivalent, the Common Reporting Standards. Eli has served as a professional of international taxation at St. John's University Law School. He has been quoted by the Wall Street Journal, Fox Business, and Bloomberg News. Most recently, he has lectured in the Caribbean and the Middle East on the asset protection and cross-border planning matters. Eli has also written numerous articles that appear in legal publications in the U.S. and abroad. Today, Eli will be speaking on tax planning for expatriation. And with that, I'll turn it over to Eli.
Good morning, everybody. Thank you very much, Jonathan, for that intro. And for those of you who haven't had the pleasure yet of reading Jonathan's comments and letters in Barron's, you're definitely missing out. The wit and the humor that goes along with the substantive knowledge there is definitely not to be missed. So definitely please check it out. As Jonathan mentioned, I'm a senior counsel at Norton Rose Fulbright in the New York City Trust and Estates Department office. My practice is primarily cross-border planning for high net worth individuals. That essentially involves planning for U.S. individuals with foreign assets or foreign individuals with either U.S. assets or U.S. beneficiaries. A big topic for the year of 2020, and I've been getting many calls about, especially since the pandemic, has been on expatriation. So expatriation is when an individual who is either a citizen or a long-term resident renounces or relinquishes such status and essentially leaves the United States. Now, in order to get an idea of why this has been such a big deal and why, to put it into context in terms of numbers, every year the federal government releases and publishes a list of everybody who has expatriated in the past quarter. That's part of the requirements. That by law, they must release those numbers. Now, for the entire 2019, the number of individuals who had expatriated was somewhere around 2,000 people. For the first 3 quarters of the year 2020, that number is at 6,000. So already we are surpassing by 3 times the amount in 2020 for the first 3 quarters than for the entire 2019. There are many reasons for that. When I get a call about expatriation, obviously recently it has been due to the pandemic. A lot of people don't want to be part of the United States anymore. They've lost faith. Any party that you're in, whether it's blue or red, people have lost faith and they want to leave the United States. Another reason why people mention they want to leave the US is due to the compliance requirements, whether it's reporting, whether it's a tax obligation. People are not interested in staying in the United States anymore. And this especially comes up with cross-border families that have, for some reason, have what I call accidental U.S. citizenship or non-intentional U.S. citizenship, and they would like to move. So those are the primary reasons, and the numbers are saying that this is going to be going on for foreseeable future, and therefore it is something that certainly we need to address and to be aware of. Now, the agenda for today is first we're going to cover. Hold on one. Okay, first we're going to cover the definition of a covered expatriate. We're going to discuss the exceptions to the definition. We're going to then address what the actual exit tax is, because there are tax consequences to expatriating. We'll discuss some of the estate and gift tax consequences. Talk about some of the mechanics in the beginning, actually, and then planning strategies to minimize the exit tax liability. So when it comes to the exit tax, what a person needs to do, or the advisor needs to do, is have the framework. So this is a flow chart that you should look at to see if the exit tax is even applicable to the client. So when it comes to expatriation and the exit tax, not every person who expatriates is subject to the exit tax. You have to be a covered expatriate under Section 877 Cap A in order for the exit tax parade of horribles to ensue. So first you look at, is the individual a U.S. citizen or a long-term resident in the United States? And we're going to define long-term resident, what the definition of that is. If the answer to that is no, easy, exit tax does not apply. So that question comes up a lot when it comes to people who are here on employee visas or other types of temporary visas. If they decide to leave the United States, then they're not covered expatriates, and exit tax does not result. Next, if the person is a U.S. individual, is a U.S. citizen or a long-term resident of the United States, did that U.S. citizen relinquish citizenship, or did the long-term resident cease to be a long-term U.S. resident? Again, if the answer is no, the exit tax does not apply. And where this comes up a lot is, and I get a lot of questions, is again, during the pandemic, a lot of individuals wanted to have alternative residencies, alternative citizenships. One example is that a lot of Silicon Valley residents and professionals, I'm sure you've seen in the papers, were moving to New Zealand because they believed they were handling COVID better. There are alternative residency programs where you can become a citizen or a resident of another jurisdiction in addition to retaining your U.S. citizenship. That's not an exit tax event. You did not relinquish your U.S. citizenship. You did not give up your long-term residency. So under those circumstances, again, the exit tax would not apply. Now, if that individual meets one of those two requirements, then we have to see, did one of three tests have they been met? And there are three tests we're going to go to: the net worth test, the tax liability test, and the failure to certify test. If any one of those three are met, then we have a covered expatriate. If one of those, if none of those three tests have been met, then you do not have a covered expatriate. Okay, and then even if you are considered a covered expatriate, there may be a couple of exceptions that apply so that the exit tax is not imposed. Okay. It's important to note that all expatriates need to file certain forms. So all expatriates need to file a final income tax return to IRS, and also IRS Form 8854. Covered expatriates, and we're going to get into the definition of that, may be required to file Form WHCE, and that depends on the assets, but we'll get into that. But it's important to know that there are some form requirements. Now, let's get into the definition of the covered expatriate into a little bit more detail. So an expatriate is any U.S. citizen who relinquish their U.S. citizenship, or a long-term U.S. resident who ceases to be a lawful permanent resident. So that gives you the definition of expatriate. Then you go into who's a covered expatriate. They have to meet one of these three tests under 877 Cap A. So either their average annual net income tax liability for the 5 previous years, ending before the expatriation date, has to be greater than $124,000. And that $124,000 is an amount that is indexed for inflation. Currently, that's at $171,000. So you look at the individual's income tax liability, and we'll get to a little bit, what that means for married jointly, not, single filers, but we'll get into that. But if their liability, average net income tax liability, the average for the 5 prior years is greater than $171,000, you have a covered expatriate. You don't even need to go to the next test. If for whatever reason we don't have that, we don't meet the net income tax liability, we also look at the net worth test. So an individual who has a net worth of $2 million or more is a covered expatriate. Now, the net worth test, what a lot of people don't realize, that a lot goes into that. So if a person is a beneficiary of a trust, their beneficial interests are taken into account for computing the $2 million value. And that's an important thing to note, because a person may think that just because they're the beneficiary of a trust doesn't mean that they have a net worth of $2 million. And where does this come up? This comes up with, let's say, young children who they're adults, they're legal adults, but they're beneficiaries of trust, and they could have a net worth of $2 million. So if their family is going to be expatriating, they expatriate with their family, they could be 20, 21 years old, they could still have a net worth of $2 million and have and be considered a covered expatriate. And then finally, even if those numerical tests aren't met, if an individual fails to certify that they have complied with all U.S. federal tax obligations for 5 years prior to expatriation, they'll also cover expatriates. This one is made on, this certification is made on IRS Form 8854. And if the person fails to make that, then they would be a covered expatriate. Okay, so we said that an expatriate is a U.S. citizen or long-term resident who gives up that status. So what do those words mean? So U.S. citizen, the determination is made as a matter of immigration law. So if a person was born to a U.S. parent, a person was born in the United States, you look at immigration law to determine whether or not an individual is considered a U.S. citizen. For those who are long-term residents and they are giving up their citizenship, their long-term residency status, we look at someone who was a lawful permanent resident. So generally somebody who is a green card holder, but it's not that they have a green card just for a few years. They had a green card in at least 8 years in the 15-year period ending with expatriation year. So you would look at those, for long-term residents, you have to see when they obtained the long-term resident status, how long they've had it for in the past 15 years, and then you determine if they give up their green card status, whether or not they are considered a covered expatriate. There are some treaty complexities that come into play, because long-term green card holders do have an option, depending on the country that they live in, to elect not to be taxed as a U.S. or to be treated as a long-term resident in the United States. But if that issue comes up, then a discussion should be had whether or not the person has met the 8 out of the 15-year test for long-term residency. Now, a little bit on the mechanics. How does one actually expatriate? So for a U.S. citizen, there are essentially 6 ways that you can do it. The most common way that we deal with is renunciation. And renunciation means essentially going to a U.S. embassy in the foreign country that you're in, presumably where you're intending to reside permanently, and you renounce your U.S. nationality. That's how you expatriate. A question I often get is, okay, I want to expatriate, I'm done, I'm leaving. And my next question to them is, terrific, where is your new domicile? Where are you moving to? And the answer is, I don't know yet, but I just want to be done with my US tax obligations. It doesn't work that way. Before a person expatriates, they must, and it's highly recommended that they have somewhere that they're domiciled in. You don't want to end up like Tom Hanks in, I forgot the name of the movie, where you're just staying in the airport all the time. You need to be able to go somewhere. And just practically, in order to renounce that US citizenship, you need to go over to the US Embassy and wherever you're domiciled and have that act of renunciation. When it comes to definitions of nationality, long-term residency, etc., we have the intersection of immigration law and tax law. But if there's a conflict between the two, and then some circumstances there may be, the IRS rules take priority. So the Department of State, the Foreign Affairs Manual, that gives us a lot of the rules regarding these matters. But the individual needs to look to the IRS when the date of loss of nationality happens for federal tax purposes. So the IRS rules have priority in terms of determining the loss of nationality or the loss of residency. Going back to how you give up your long-term residency status. So there are really two ways. One is through abandonment. So the individual voluntarily gives up permanent residency status and they file Form I-407. That's really the most common way. The other way is that the government actually terminates the permanent residency status through certain proceedings. But really it's abandonment that we see in the context of the exit tax more frequently. Another question that I get a lot is, hey, my green card has expired. I'm overstaying it. Am I still obligated to file US taxes? Do I need to leave the country? Am I considered to have been subject to the exit tax now? In terms of immigration law, that's a separate question, what you should be doing in terms of fixing that so you're not in the United States against the law. But this does not mean that a green card expiration does not mean that an individual has abandoned or revoked their long-term residency status. They're still a US taxpayer. They're subject to US taxation or worldwide income. They have to file their 1040s. So that's not relinquishment, or that's not abandonment or revocation when the green card expires. Okay, so now let's get into some of the tests to determine whether or not an individual is a covered expatriate. So the assumption is that the individual is either a US citizen or long-term resident. And again, long-term resident is 8 out of the prior 15 years. 2, there was an expatriation event, meaning that the individual either abandoned or revoked their long-term residency, or they actually renounced or relinquished their US nationality. So let's assume that that's already done. So now we got to figure out, are you a covered expatriate? So the first test we'll look at is the net income tax liability. So as we mentioned, we look at whether the average income tax liability for the 5 prior years is equal or greater than $171,000. And as I mentioned, that's for that amount is for 2020 because that's a amount indexed for inflation. In terms of computing tax liability, we look to Code Section 38 C1. The net investment income tax does not apply for this test. Self-employment taxes don't count for the 171,000. And another question I also get is for married couples filing jointly, you can't divide it and say, oh, this is my share of the tax liability, this is my spouse's share. If you're filing jointly, you look at the total amount that you're liable for on the income tax return. Of course, it's good to note that if an individual is a grantor of a trust, which many of our clients are, and they are considered the grantor of the trust for income tax purposes as well, for they have done estate planning, any income that they're picking up from that trust because of the grantor of that trust, that comes into this calculation. It's not just because the trust is not a separate taxpayer for income tax purposes, and this number definitely comes into play. That this may count, this may be or becomes relevant in the event the individual wants to see if, for whatever reason, if they can make their income tax liability come lower, if they're planning on expatriating, they may be able to turn off grantor trust status, but that's just part of the general planning for later on. If an individual knows and wants to proactively, an individual knows they want to expatriate, they can proactively plan to somehow not fall under one of these tests. But that's for income tax liability. The net worth test. So this is not a number, as I mentioned, indexed for inflation. And if individuals' net worth is greater or equal than to $2 million in the day of expatriation, they meet the net worth test and they're covered expatriate. The way what assets are included. So first of all, in general, the net worth means you subtract your liabilities. So if there are liabilities in place, there's a mortgage on the house or other types of liabilities out there, you subtract that to get to the net worth. The assets that are included generally are the assets that, if giving it away, would be a taxable gift. So those assets are what's considered to be included in the net worth test. As I mentioned, you must include the value of beneficial interest in trust. So if an individual is a beneficiary of a trust, they're going to have to include that value for the $2 million net worth test. How do you determine what your beneficial interest in the trust is? So generally, you look at the pattern of distributions that have been made to an individual. Let's say it's a trust that's $4 million. There are only 2 beneficiaries, and your client's one of them. So presumably, 50% of that belongs to one beneficiary. However, if you can show through a pattern of distributions that all the income and principal has been distributed to the other beneficiary, even though they both were the discretionary beneficiaries of a pot trust, nevertheless, you can show that possibly that amount should not be included as part of the $2 million. But again, that's something to look at. I want to mention also that there's IRS Notice 2009-85, which has a lot of chock full of information about how to make certain calculations and what's included and what's not included under the expatriation rules. So it's something definitely, if you have a client that is looking into expatriating, you must review, aside from the code section, 877 Cap A and 2801 for the estate and gift tax issues, you must review IRS Notice 2009-85. Certification test. This is what one of the last tests that we look at. And assuming the individual did not meet the net worth test or the income tax liability test, what we do is we look at whether or not the individual fails to certify that they met the requirements of this title, meaning the entire Internal Revenue Code for the 5 preceding taxable years. So that means self-employment taxes, estate and gift taxes, anything that's conceivably under the code, the individual has to certify that they've complied with those requirements. Now, what does compliance mean? Let's say there was an error on a tax return. That's not really considered not compliance. We have to make a distinction between substantial versus non-substantial compliance for the individual making that certification under penalties of perjury. So I get that question a lot. Oh, maybe one of my deductions was incorrect. That's not what the IRS is looking for. They're looking for real substantial non-compliance or fraudulent returns in that sense of not filing that certification. So one important exception that comes up. So let's say you did meet you're a U.S. citizen or long-term resident. There was a abandonment or relinquishment of that status. That individual met one of those 3 tests. Are there any exceptions? So there are 2 exceptions, but I want to focus on one because this comes up a lot. And this is really aimed at children who obtain U.S. citizenship status, not necessarily because they wanted to, but either because their they were born in the US while their parents were here, or they were born to a US parent, well, whatever the case may be. And now that child does not want to be subject to the US tax web. So they could even be living in a foreign country now. They could be, they were born in the US, their parents moved to a different country, to Switzerland. I had this case recently. Parents moved to Switzerland when the child was 16 or 17. And now she does not really want to have US citizenship. They're never planning on coming back to the United States. They have no ties here, no business ties, no family ties, nothing. And the child is now going to be subject to US worldwide taxation because of their US citizenship. So one way that that child can not be considered a covered expatriate is if upon once they reach age 18, that's the legal age generally that they can they're an adult and they can give up their citizenship. Before attaining age 18 and a half, and that child also has been a resident for maximum of 10 years before the date of relinquishment, that child can go ahead and relinquish their US citizenship without being considered a covered expatriate, no matter what trust has been set up for them and whether or not they meet the net worth test. Even so, they can still relinquish their US citizenship without becoming a covered expatriate. And that really comes up a lot with families that have moved out of the US. Now, I realize I'm running a little bit short on time, so let me just quickly discuss the income tax effects of 877 Cap A. Individual expatriates, so what do we look at? We have essentially three categories. We have specified tax deferred accounts, so that includes IRAs, deferred compensation, and trust distributions. What happens with those categories? And in my slides later on, you'll see what each of those categories are. Specified deferred accounts, such as IRAs, there's a deemed distribution on the day of expatriation, no distribution penalty. Deferred compensation items, it depends whether or not it's an ineligible or eligible compensation items. So either if it's ineligible, there's a tax as deemed present value of the lump sum distribution. If it's an eligible item, then there's 30% withholding for the future. There's not much you can do in terms of planning for that. For trust distribution, so if an individual is the beneficiary of a non-grantor trust, in the future, and that doesn't make a difference if the trust is foreign or domestic, in the future, if that trust makes a distribution to a covered expatriate, there's a 30% withholding there. And that's important to note because that can actually, you can have some planning prior to the date of expatriation to avoid that. And this is a big hit with all other assets that the individual has. There's a deemed sale as if the individual sold all his or her assets the day before expatriation. And the first $737,000 of capital gain that is recognized on that deemed sale, even though there was no cash there, is exempted from taxation. That's for 2020. That's an amount that's indexed for inflation. So again, for these items, I highly urge you to look at IRS Notice 2009-85, but specified deferred accounts includes IRA, Roth IRAs, HSAs, medical savings accounts, etc. Does not include SEP or simplified retirement accounts, which I know Jonathan deals with a lot. So don't worry about those, Jonathan. Deferred compensation items, as I said, there's a division between eligible deferred comps and ineligible, and different tax rules there. We discussed the withholding rules for non-grantor trust. So again, if you have a client that is the beneficiary of a non-grantor trust, whether domestic or foreign, there's going to be a withholding requirement there, and it's important to somehow plan around that to the extent that's possible. And we've done that for clients before to ensure that that 30% withholding consequence is mitigated. Okay, let's jump forward a little bit to the 2801. So covered expatriate, we got two main consequences. It's the income tax consequence, then you got estate and gift tax consequences. So estate and gift tax is covered under section 2801. So what is that? Essentially, if you have a covered expatriate and you have a US recipient in the future who receives a covered gift or bequest, you got a 2801 tax liability. What is that? So basically that says that if you have a covered expatriate and that covered expatriate is going to be making a gift in the future to a US beneficiary, we're going to have a 40% tax to the donee, to the recipient, not to the donor, not to the covered expatriate on that gift. And there are certain exceptions that work and certain exceptions that don't work. So for example, you can't claim some of the exemptions. If it's a non-resident alien, generally, if they're transferring an intangible, there's no tax on that transfer if it's an intangible in the US. So you have a non-resident alien transfers an LLC interest here in the United States, you don't have a tax on that. But when it comes for a covered expatriate, that exception does not apply. Some exceptions do work for gifts by covered expatriates, so they're not subject to that straight 40% taxation, meaning the donee, the one who receives the gift. If the gifts are made while the covered expatriate is a U.S. resident, marital deduction transferred between citizen spouses, that comes up a lot. QDOTs, which we use a lot, primarily when dealing with non-citizen spouses, charitable transfers, those are not necessarily gifts or covered gifts for purposes of Section 2801. Now, how does 2801 work mechanically from a compliance point of view? What we need to do is have the individual file Form 708 and make a tax payment. Guess what? Form 708 has not yet been published, and no payment of tax is required until we have final regulations, which also have not been published. So we are in a bit of a limbo stage with that, but it still pays to think about, if you have a client who's a covered expatriate, to consider the Section 2801 consequences. Now, there are certain things you can do. You can make gifts to the citizen spouse before. You can make gifts and use your 11.58 million exemption. The current 11.58 may go down, but use that exemption while the person is still a citizen. But there's certain things that can be done there to mitigate that tax. Let me just see how much more time we're coming to almost a close. So if I take 1 or 2 minutes of your time, some ways to mitigate the tax and not be a covered expatriate is, let's say for the net worth test, make gifts to your spouse who's not expatriating. That's one way. Tax liability tests. Possibly consider filing separate, even if you're married. Do married filing separately. That could reduce your income tax liability. Consider gifts to U.S. citizens and residents, again, beforehand, before expatriating, so that afterwards you're not going to have an issue. But all this goes into the planning and emphasizes how important it is to plan for individuals considering expatriating because of the income tax as well as the estate tax issues and consequences that could come up. Few takeaways: it's relatively easy to avoid the net worth test to not become a covered expatriate. It's also very easy to avoid the certification test, and that's by making sure you've been compliant with your tax obligations. It's not easy to avoid the net income tax liability test necessarily, but that there could be some planning, as I said, with married filing separately, or having grantor trusts converted into non-grantor trusts if you were the grantor of those trusts, so you don't have a tax liability. Finally, file all appropriate forms: IRS Form 8854, the final income tax return. If you're a green card holder, Form I-407, and you're relinquishing citizen long-term residency, those are important things to file. One last point before we end off: a very common question I get is, let's say I expatriate, and after a few years I regret it. I want to come back to the United States. I've heard of something called the Reed Amendment that says they may not let me back. What's the story with that? So the first thing I would say is, giving up your US citizenship is a very big deal. So make sure and be 100% sure that it is in your best interest or your client's best interest to give up that status, because the tax liability or the tax reporting may not be sufficient enough to do that. So make sure you're certain about that. And in terms of the Reed Amendment of being let back into the United States, the answer is practically you are. The Reed Amendment that says you won't be let back is generally for people who did it for tax reasons, they expatriated, and tax avoidance. But what we've seen is that individuals who expatriated, they come back and they go back and forth from the United States all the time. Commonly comes up where one spouse decides to expatriate, the other spouse stays in the United States with the children, and the spouse who expatriated wants to come back. The answer is that practically we have not seen an issue with that. With that, I thank everybody for participating today, and thank you, Jonathan, for putting this together today.
Great, thank you so much, Eli. And if anybody wants to get in touch with Eli, I mean, he ran through the program pretty quickly. There's a lot here. I'll be sure to include his email address in the follow-up email to this program. You can email him directly or email me if you have any questions directed at me. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Just 2 items before I let you go. The first is to please stay tuned for my winter webinar series. In the coming weeks, you'll be receiving an invitation with the full lineup of webinars. There should be a great group of speakers on a variety of wealth planning topics. Additionally, after this program ends, you'll receive a 2-question survey to help me continue to improve my webinar offerings. Kindly take 10 seconds to fill it out if you can. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.